Mike Brown, and today we're going to be talking a little bit about estimating uncollectible accounts receivable. Now, remember our core principle as it relates to receivables. We're going to record it at net realizable value. We've talked about that discounts are one of the things that can affect that net realizable value. But another big one are if they default. If they do not pay their bill, we call that, of course, an uncollectible account. So we're obligated to record receivables net or reduced by this amount of uncollectible receivables. Now, we could do this in a couple of different ways. And I'm going to use an illustration here. Think of a basket full of apples, right? Now, we always say, right, a bad apple spoils the batch. It's not really the point here. But let's say we've got 100 apples. Now, we know going in, some of those apples are inevitably going to go bad. Maybe we think 2 are going to go bad. Maybe we think 4 are going to go bad. That's what we call the allowance method. It's not where we say, oh, it's that one. But we think, well, I have a pretty good idea how many apples will ultimately go bad. I just don't know which ones they are. So the allowance method says, I'm going to make a best guess estimate of that. And that's what we call an allowance method. We're going to make an allowance that 3 or 4 or 2 or whatever apples are going to go bad. That's not the only method, though, but it's the only one that's GAAP. The other method that's used is called direct write-off, and that's where we wait for an apple to actually go bad. So the minute that apple starts turning funny colors, we go, aha, that one's a bad apple. Let's write that apple off. Think of it as, I'm going to chuck that apple out of the basket. That's fine. That is, at least mathematically, makes sense. And there is an entity that uses that, the IRS. This is how tax write-offs, or how you get to record bad debt expense for tax purposes, kicks in. But it is not how it's done for accounting purposes. All right, so let's expand a bit on the direct write-off method. Again, it's not GAAP, but it's important to know how it works, mainly because of its tax implications. So, when do we write off the account? Well, it's triggered, the bad debt expense is recognized, and the account receivable would be written off as a result when it actually becomes uncollectible, when we figure out that's the bad apple. Now, it has a number of problems. The reason GAAP doesn't allow this, one is it doesn't follow a fundamental principle of GAAP, which is the matching principle. It doesn't properly match the bad debt expense to the revenue which gave it rise. There's another weakness. AR is always going to be overstated as a result, right? It's always going to be not truly net realizable value. It's going to be net realizable value plus the amount that I'm going to write off eventually. I just don't know how much yet. Because there's no allowance. There's no allowance at all. There's no attempt being made to account for those future bad debts. So that's why US GAAP says, fundamentally, this doesn't fly. It does not jive with what we expect from accrual basis accounting. The IRS, on the other hand, says, yeah, that's fine. So that's how they do it. All right, so let's look at a quick example of the direct write-off method. So let's say December 15th, year 1, Roe Company recorded a sale to the tune of $10,000. So debit accounts receivable, credit sales. Now, several months later, July 1, kind of makes sense. They have not paid in 6 months and then some. The company has decided, you know what, we're not going to collect this. Maybe the sale was to a company that's gone bankrupt. Who knows? So now, under the direct write-off method, what are we going to do? Well, we're going to recognize a bad debt expense now for the full $10,000, and we're going to credit the account receivable directly to write it off. This is a great illustration, though, of why GAAP has a problem. This is not matching principle. Where's the revenue? It's in year 1. Where's the matching expense? It's in year 2. They're not in the same period, and they darn well should be. So that's why this is an acceptable method under US GAAP. All right, enough talking about the direct write-off method. Let's talk about the one that is GAAP, which is the allowance method. And the allowance method falls under an umbrella called CECL. I know, that seems like the weirdest name for an accounting rule. But what it stands for is Current Expected Credit Losses, CECL for short. But a way to think about that is it's the same as, it's equal to past, present, and future. You might think, what do you mean past, present, and future? It means that when we come up with the allowance, we should include the past, meaning, well, what's our past experience been? It should include the present. what is the condition of this specific receivable, what are we actually selling and what kind of customer, all of that, and the future. What are my expectations for payment in the future? In other words, we're looking at the possibility of a loss being incurred over the entire life of the receivable. Now, that's the expected credit loss part. That's the ECL in CECL. But it's current, meaning as of now. What do we believe currently is likely to happen? So what we're going to do is we're going to deem that a certain percentage of our accounts receivable is not going to be collectible. How do we deal with that? We're going to charge bad debt expense. Unlike the direct write-off method, where we did that when it went bad, we're going to go ahead and preemptively recognize bad debt expense. Now, we don't know which apples are going bad. We're just guessing how many will ultimately go bad. We will then credit a valuation account, typically called the allowance for doubtful accounts. And that's going to reduce total AR to its net realizable value. Now, what happens when we say, oh, well, again, with our basket of apples, we said we think 4 are going to go bad. Well, what happens when 1 does? We go, that must be one of the 4. Okay, what do we do? Well, to write it off is a little simpler. We've already recognized the bad debt expense. What we need to do is get rid of the account receivable. So what's the other side of the entry? We get rid of the allowance. Okay, so we have 2 different general ways to compute the allowance. Now, they're really not that different because they're both based on the balance sheet, but one is just a bit more detailed. We'll start with the one that's a little more simplified. It's the percentage of accounts receivable, or you could even think of it as the percentage of total accounts receivable. Because all we're going to do is we're going to calculate the ending balance of what should the allowance be based on how much receivable we have outstanding. What that effectively means is we're going to plug bad debt expense. Think of it as, well, the allowance is currently at X. We need it to be up here at Y. Therefore, what's the difference? The difference is bad debt expense. That's how much we're going to recognize. All right, we have DEF company. DEF says we're going to use that percentage of total accounts receivable. And they say our normal rule here is we're going to allow for 2% of whatever is owed to us as uncollectible. And at the end of the period, they say, yeah, we have a balance of $80,000 in accounts receivable. So we're going to say, okay, then the required ending balance is $80,000 times 2%. That's $1,600. Then I need to know, well, what balance is sitting in there now? And it tells us, well, before adjustment, there's a $1,000 credit balance. Okay, well, the allowance should normally have a credit balance, right? It's a contra asset. It's reducing AR. So yeah, that makes sense. So we're saying, all right, well, we've got 1,000 in there now. We need to have a 1,600 in there, so we're missing $600. That's my plug. That becomes my debit to bad debt expense and my credit to the allowance for doubtful accounts or allowance for uncollectible accounts to the tune of $600. Now, I ask you one interesting question. What if it hadn't been a credit balance? You might say, well, what do you mean? It would be a subtle thing to do in an exam question, don't you think? What if instead of saying $1,000 credit balance before adjustment, let's say, oh no, it had $1,000 debit before adjustment? It doesn't look like much of a change, but what it means is we're going from an allowance that was actually negative 1,000 effectively, and we've got to get it from negative 1,000 all the way to 1,600. That would result in a $2,600 adjustment. So be careful. Really, I like to think of it as anytime they simply put the balance in the text of the question, make sure you understand whether it's a debit or a credit, because it's an easy, kind of sneaky thing to do, but there have been exam questions that do exactly that. Now, I mentioned that both methods are effectively the same in as much as they both deal with the balance of accounts receivable. The first is more general. This is more detailed. It's more granular. We call this the aging of receivables method. What we're going to do here is instead of just looking at the total as one big block, we're going to say, oh, no, what we're going to do is we're going to categorize it based on how long that receivable or those receivables have been outstanding. Maybe we do it based on months or days or weeks or whatever we want. And then each category will be assigned a percentage. The idea here is the older the receivable gets, the higher the odds are it's going to go bad. Then we simply sum all of those products. Kind of a weighted average almost, if you like, of the allowance, or figuring out the allowance. But why don't we look at an example? So we're going to return to DEF Company once again. This time they say, oh, actually, we're going to have a little bit different balance. We're not going to have that $80,000 balance. What we're going to do is we're going to say, yep, we start the period with a $1,000 credit in the allowance account. What's important about that is we end in the same place. We're going to figure out what was the allowance and what does the allowance need to be. But in this case, they say, oh, well, actually, the balance of outstanding receivables is only $25,667. Now, if we were doing the 2% method, that would be an awfully tiny amount of allowance. We'd think, what, a little over $500. But once we get into the details, we see why that's not a really good idea. So they said, yeah, what we're going to do is do it in blocks of 30 days. We have current, because maybe we say normal terms are net 30, so we expect our customers to pay us within 30 days. Then we'll do 30 days beyond that, and 30 days beyond that, and then anything older than that. So you'll notice that the categories, although there's 25,000 and change outstanding, there's 9,000 that's over 60 days old. That's pretty old. So what they do is then they say, okay, if it's current, we assume 99% of that is going to get collected. We're going to assume at a 1% uncollectible rate. If it gets to be 30 to 60 days, we're going to bump that up to 3%. Goes 61 to 90 days, we're going to bump it up to 10. And if it gets older than 90 days, 20. Now again, that's CECL, right? We're basing that on what is our past experience telling us, what is the present status of these receivables, and what are our future expectations. All we then do is take each percentage times the balance in that category. So we end up with an allowance of $100 on the current piece, $200 on the 31 to 60 piece, $500 on the 61 to 90 piece, and $800 on the over 90 piece. So we end up at $1,600, funny enough, just like we did in the previous example. But note that is still much more than 2%. But they would say, given how much of our receivable balance is old, that's probably appropriate. And so that's how they come up with the allowance. And then bad debt expense would simply be the adjustment necessary to bring that balance from what it was to what it needs to be. So it'd be the same journal entry. Okay. Hope that was helpful.